A note before you listen. BusinessDesk reached out to Duval founder Kenyon Clark several times to ask him and his wife Charlotte Clark to participate in this podcast. While those requests were declined by the Clarks, they did tell us that the allegations made in this podcast are factually and legally incorrect. At the time of publication, New Zealand's markets regulator, the Financial Markets Authority, continues to investigate the Duval Group, and to date, no charges have been laid. Our invitation for the Clarks to talk to us and share their side of the story remains open.
In the last 30-odd years, how much do you think New Zealand's house prices have increased? 300%? 400%? In fact, they have gone up 648% since 1992, not taking inflation into account. It is not hard to see why people view bricks and mortar, or more accurately in the local context, Pinus radiata and Jib, as a solid investment bet. It's also not surprising that property investment schemes of various kinds pop up perennially, offering Kiwis a surefire pathway to financial independence. Prior to Duval, one of the most infamous of these was Blue Chip, led by Mark Briers, the charismatic son of an All Black, a big-spending founder worth a reported $70 million at his peak. Blue Chip failed in 2008, owing an estimated $84 million to more than 2,000 investors.
And I was suddenly talking to a guy who had put the proceeds of a farm sale or something like that into Blue Chip and lost it, and it was $1 million.
I think it's a small percentage of people that carry those scars and talk about it. I think a lot of others take no lesson from it at all, and it's forgotten about in 10 years' time, and the cycle keeps repeating.
Any of us can be vulnerable to an extremely well-pitched, well-presented, charming individual absolutely forming a relationship, making us feel special and selling a solution to the problems that we have.
Are Kiwis destined to keep repeating the cycle of investing their life savings, their homes even, in questionable property schemes? I'm Maria Slade, and this is Safe as Houses, Episode 4 of The Fall of the House of Duval. The image of two distraught blue chip investors clinging to each other outside the West Auckland home they were about to lose has always stuck with me. It was May 2011, and a Herald on Sunday photographer and I had gone to interview the couple because they were the first to face the mortgagee sale of their house thanks to the failed scheme. The tension and grief in the air as they cleared out the family home they'd once had big plans for was palpable. I'm an investigative business reporter, and I covered Blue Chip and the fallout from it for several years.
Mark, have you got anything to say to investors? Have you got anything you want to apologise for what you've done?
Are you going to say sorry, Mark? Where's the 173 million, Mark?
How are you going to do?
What have you got to say to
message have
investors,
you got
Mark?
to say to investors?
What have you got to say to investors?
That's Radio New Zealand's Morning Report, covering Briers' sentencing in the Auckland District Court in 2010. Investors like this couple had been bitterly disappointed the year before, when Blue Chip founder Mark Briers faced only bookkeeping charges and escaped jail.
They needed to change. It's been done now, and they've got someone doing it now, but this should have happened 2 years ago. Yeah. And it hasn't if we haven't been in touch with them.
It's given them huge information, and nobody does anything about it.
At the time, I kept in touch with a lot of Blue Chip investors, such as Don Lawton, now a retiree and keen croquet player, living in the Hauraki Plains town of Paeroa. I hadn't spoken to Don in years, when suddenly, in early December 2024, he gave me a ring. What prompted him to pick up the phone was the sentencing of Mark Briers to 8.5 years in jail in Australia for tax fraud. As we catch up, I tell him about my work on Duval, and Don mentions something that makes producer Hamish and I hop in the car and take a drive to the town famous for its giant lemon and Paeroa bottle. As we sit in the lounge of his modest home, Don tells us he was just an ordinary working bloke when he got involved with Blue Chip.
Right, well, I'm retired now for a few years, but I was a spark technician from September 1977 until 2019.
Don's family invested heavily in Blue Chip, not least because of a significant connection.
Well, my uncle Jock, he was my mother's brother.
Don's talking about Jock Irvine, a director on various boards and a former senior partner at law firm Simpson Grierson.
He was the chairman of Blue Chip, but my dad had actually got into the Blue Chip investment first because he saw all this money for nothing sort of idea. Don't have to do any work for it except for putting your house at risk, if you like. I think that risk wasn't actually ever thought of as such at the time. And my brother got one, and I was slow to do it, and I just thought, well, what was going to be the outcome? It didn't sound like we were going to make lots of money out of it. But at the time, if it was even 50k or whatever we thought, 100k, sounded like it would help in retirement years. Yeah.
And did you speak to your Uncle Jock about it?
I didn't actually bother too much speaking specifically to them because I trusted the name of this company because he was associated with it.
Blue Chip seemed to have all the right credentials. It was listed on the Australian Stock Exchange, boasted former cabinet ministers Wyatt Creech and John Luxton on its board, and sponsored the New Zealand Golf Open. Oh! Under the Blue Chip scheme, investors borrowed against their homes to put down deposits on yet-to-be-built central Auckland apartments. Blue Chip paid them huge returns for the use of that deposit, covered the mortgage, and was supposed to buy the apartment once it was completed and return the deposit. But the global financial crisis hit, it all came crumbling down, and investors were left having to settle on apartments they didn't want at inflated prices. In one story I wrote, an elderly widow discovered she hadn't in fact bought an apartment, but a car park next door, and she didn't even have title to that. Don and his former wife had invested in the yet-to-be-built Ascent apartments on the CBD fringe.
I was living in Manurewa and had the average sort of family house worth about $330,000, and that was strangely the exact amount that Blue Chip would get financed. They would look at the value of people's property and say, oh well, we can obviously take $330,000 from me and $500,000 from someone else. But what we didn't know as naive investors is what were those properties we were buying really worth? What were they going to be worth? And that was a eye-opener as time went on.
Blue Chip had steered the Lawtons in the direction of Jonathan Mathias for advice, a supposedly independent lawyer who was later found guilty of misconduct for failing to warn investors of the risks. The couple eventually managed to sell the apartment, but it cost them.
So you lost $100,000?
We exactly, lost $100,000. And thank God we lost $100,000 because one day I was at work and I was talking to a customer and just happened to mention the Blue Chip for some reason. She says, oh, I'll go and get whoever the man was. He lost $1 million. And I was suddenly talking to a guy who had put the proceeds of a farm sale or something like that into Blue Chip and lost it, and it was $1 million. I was gutted for him.
The collapse took a huge toll on the Lawton family, and Don found himself in a dark place.
When you are at that point in your head, you start to think silly thoughts. Yeah, so I was a bit depressed anyway. I think I've been a bit bad at that, and I ended up having a few antidepressants and things like that.
Fast forward a decade, and imagine Don's surprise to receive a letter from Duval, suggesting he might like to invest. This is what prompted Hamish and I to drive to Paeroa, the idea that history could be repeating itself, and an ordinary working bloke was being targeted by yet another property scheme. For Don, it was all too painfully familiar.
Yeah, that was a sad feeling to see that someone else would start up and start looking like they were going to behave in a similar way.
We need to be clear here that Blue Chip was set up differently to Duval, and neither Duval nor its founders have been charged with anything. But there are similarities between the schemes. A housing boom, investments being offered in properties the group itself was developing, the promise of big returns, impressive marketing to ordinary mums and dads, tame advisors, and a sudden downturn. Don's work as a telecoms technician took him all over town, so he was familiar with Duval's projects. The Manukau Telephone Exchange was in Lakewood Court, adjacent to Duval's flagship project, the Lakewood Plaza apartment tower.
So I saw this going up and I thought, oh, maybe they are reputable. But as soon as I had the Duval letter in my hand, I wasn't ever going to touch it. I'd had enough burn in my life.
From his experience with Blue Chip, Don learned the hard way that there's no easy route into property investment.
I think I realised that these things are a heck of a lot more risky than we know. I'm not sure if it's a Kiwi thing. Why do we do these things? And what I think we make is a fundamental error in understanding how the risks of it can affect us. I was a risk-averse person probably, but when I saw other people making money out of the real estate market, I thought that, well, this is a good thing, but misunderstood the apartment market.
New Zealand will always have housing cycles, sure as God made little green apples. As the property market comes out of the current downturn and house prices start to grow again, it would be nice to think we're a bit wiser and won't go chasing the gains of booms past. But what's different this time around is the market has entered a new era, and that has big implications for Kiwis thinking the property good times will keep on rolling. Let's bring Sharon Zollner back in here. She's chief economist at ANZ, and the bank is forecasting a very different scene in the next few years.
Well, housing's had excellent returns on average in New Zealand over the last 30 years. And so, you'd think, well, if you can't look at 30 years of history and make a decent projection, then what can you look at? But, as any financial advisor will tell you, past returns may not be a good guide to future returns. And what's happened over that 30 years is that interest rates have trended down and down and down, which has meant that the amount of debt that households can service has gone up and up and up. And that has enabled house prices to outpace incomes over decades. But interest rates hit rock bottom. They actually went negative in some countries. So the next 30 years are not going to look remotely like the last 30 years. We will not see an upward trend in the amount of debt that households can hold. And therefore, the last 30 years of housing performance is extremely unlikely to be repeated.
Sharon says on the investment side of things, low interest rates push people to take more risks as they chase better returns. That pushes up asset prices. And then FOMO kicks in, and that pushes them up even further, and next thing you know, you've got a full-on asset bubble. Sharon is far from alone in forecasting that the property market will take on a very different shape as it recovers from the bursting of the 2020-2021 bubble. With a great sense of timing, just as we put together this episode, Forsyth Barr drops a report entitled "The House Doesn't Always Win." Forsyth Barr is a fancy investment services firm and regularly puts out these reckons. It says house prices are still down 16% from their peak in 2021. And meanwhile, council rates, insurance, maintenance cost and mortgage interest rates have risen. Plus, housing supply has outstripped demand in the last 5 years. In short, property investors' costs have shot up, leaving them relying on capital gains for a decent return. But those capital gains will be harder to come by. Forsyth Barr predicts house prices will now rise roughly in line with household income, which historically has grown about 3.5% a year. It says,
"The landscape in 2025 looks very different from the one that fueled the previous decades-long boom. We suspect those expecting house price growths at levels seen in the past will be disappointed."
Capital gains from property as a means of escaping financial drudgery were part of the promise of Duval.
I believe it's important to ask yourself, how good can life get if I was free? I'm an advocate for your freedom. I'm an advocate for my family's freedom. The poverty cycle is generational, and so is the cycle of actually building generational wealth. I encourage you to be the first one in your family to make it out of the matrix and to lead the way for future generations.
That's Kenyon Clark in a promotional video for his Property Masterclass. It's this kind of grandiosity that's kept Chris Walsh and Dean Anderson glued to the Duval saga. We met Chris in episode 1. He's the publisher of personal finance website MoneyHub. Dean Anderson is the founder of investment manager Kernel Wealth. And for this pair, watching the financial markets is not so much a professional interest as a passion. So the morning after MoneyHub's inaugural conference in Queenstown in June, I grabbed them both for a chat.
I'm still waiting for the big MoneyHub Money Show one day.
That's coming. I've already got quotes in from ASB Showgrounds. That's coming fast.
The event has gone well, and as we sit looking out over Lake Wakatipu on a beautiful but near-freezing day, the two of them ruminate on what gave rise to Duval. As a money manager, Dean is constantly bewildered at the national predilection for putting hearts and souls into property schemes.
It's sort of an area that we watch more from concern about the lens of the investor and why do people get attracted to it, and sort of this repeated behaviour we see in New Zealand of Kiwis being attracted to basically, particularly older Kiwis, putting their whole life savings into investment schemes, really not aware at all of the sort of risks that they're taking on board. And the thing I think that astounds me is we just keep repeating this, despite very public failures and coverage of dangerous sort of set of circumstances, and yet people still keep going back and back and back and repeating the same thing. I think that's the thing that we need to figure out how to address here.
Dean believes the magic 10% provides a clue. Many of these investors are coming out of term deposits and are old enough to remember the days of 25% interest rates. To them, a 9% return might not sound quite enough, but on the other hand, 17% might seem a bit much.
But many others have got this 10%, and I don't know whether it's a double-digit thing, how the psychology plays into that, but 10 does seem to be a very repeated return element that many mortgage-backed funds or other schemes that are out there are advertised through newspapers. And it's being that sort of competitive alternative and benchmark to term deposits, right? You know, it's a few percent above a term deposit, and I think that's what they are targeting, those investors who are going, actually, why settle for 4% when 5% and get 10% through us?
Chris says as a personal finance website, MoneyHub gets inquiries about these offers.
And this is the issue because, of course, we can't comment. Look, we may have a review of some of these things, we may not. What we had here, though, is with Duval, is it was a time where interest rates were really low. People were seeing these 10%, but also this was property. And it was at a time when property kept going up and up and up. So people are seeing, this frenzy. Well, they're building properties, and we're told in New Zealand that property is a great asset, which it is to some degree. So it looks safe.
He says it is simply not worth his while digging into whether these kinds of unregulated offers are safe or not. Remember financial planning website Your Money Blueprint from the last episode? It found itself in extremely hot water for writing a critique of Duval's mortgage fund. And Chris doesn't want to go there.
I, fully upfront here, would not review something like Duval for the risk of problems. If I put something out there, for example, if there's some sort of exotic product and I do a review, there is so much risk that comes with that, not from a regulator, but from the people that you review. And I've been caught out by this before. So I'm not prepared to get entrenched in glue for doing something interesting and useful. I'm just not prepared to do it. It's not of a yield for me, and I don't want the drama. No one else will do it either. So when you see these offers, then it is at your own risk.
Dean says an important part of the psychology of why people invest in these high-returning schemes is because no one can see the end of a boom. And Kiwis think property will always ultimately go up.
So if you're a retiree, look at this, go, you're seeing a company that is sponsoring rugby teams, that has a big social presence, that seems to be rolling in cash. And that's the game. Present this image of ultimate success, tying it to an asset class that people also just think never goes down. Why would it not be safe? 10%, that's so easy. But if you think about back to the finance companies, similar things played out, right? It relied heavily on brand profile. We had a lot of well-known people presenting and facing stuff. There is the game of ultimately selling here. And a lot of financial services rely heavily on it, is marketing 101.
This was where Duval excelled, and they knew the playbook.
Build trust, and they'll do that in whatever means possible through endorsements or leveraging off asset classes and returns of those asset classes in the media, right? So those key elements keep repeating, and in times of when everything just feels like excess, nobody thinks about the downsides, nobody thinks about the risks.
As we heard from Duval investor Kate in earlier episodes, there were people who both invested in the funds and bought houses off the plans. And like a lot of property developers, the Duval model required settlement on those properties to keep the cash flowing and get projects finished. Dean Anderson says now the New Zealand property market is at a turning point, and there may be a bit of a hangover before Kiwis really get it.
A lot of property development over the past few years have seen players come in ultimately trying to develop relatively quick, very cost-effective to build investment townhouses at scale. The build materials probably won't be that structurally sound for a long-term tenant, so you've got high maintenance costs. But again, from an investor perspective, they're able to play the rules of the game at the moment, which is a much lower entry point for an investor. So, if you're thinking about an investor who's trying to buy a property and who a lot of Kiwis have only built wealth through property or have heard that property is the only real way to build wealth, again, it's quite easy to go and say, hey, new build townhouses, much lower entry point. Don't worry about the negative cash flow. Don't worry about the maintenance costs in 10 years. They're probably higher than we're forecasting. It's easier to get into, and you're not going to have to worry about anything because it's new, right?
It's human nature to fall for the promise of a golden ticket. And Dean says the older generation, who've been susceptible to putting every dollar into a single investment, are also being driven by a deeply ingrained instinct.
Part of this is almost like a long-term challenge from New Zealand, going right back from that post-87 crash. And it also ties back to the imputation credit regime.
We need to take a quick pause here for an explainer. New Zealand's unusual imputation credit regime props up our national obsession with getting an attractive income or yield from an investment rather than considering how much that asset might grow in value. Imputation credits were introduced here after the 1987 share market crash, and they give people a tax break on the dividends or returns that they earn from shares they own. It works like this. A company pays tax on its profits at the flat company tax rate of 28%. When it distributes those profits to shareholders in the form of dividends, the tax has already been paid, so it attaches imputation credits to those dividends. Shareholders can then use these as a tax credit to reduce the amount of income tax they pay. Carry on, Dean.
That skews a favour to income, right? And people were quite fearful of the stock market for a long period of time. That drove a big shift towards property. But as a result of that, we almost have a market, even the companies that are listed here, where we're much more focused in New Zealand on dividends and yield. And so for decades now, Kiwis have been drawn to yield and dividends as the leading conversation around investment returns rather than growth. And so whenever you have a foreigner that comes here and they're in the US or others, they're looking and saying, why are Kiwis just so focused on yield? Like you look at the makeup of our NZX 50, you look at what happened with the finance companies, you look at now the mortgage funds. The result of these several decades of sort of structural design has led to this more yield focus, and the products that we see now in New Zealand are things like mortgage funds popping up because they appeal to that just long-term trend, even term deposits. Astounding amount of money sitting in term deposits.
So, how do we crack this dyed-in-the-wool local bias towards getting income now over future growth? In Dean's view, it's going to take a lot of education and probably a generational shift.
What astounds me is I see it now at the 18 and 20-year-olds. I see people posting on Instagram at 18 years old celebrating dividends. And they're 18 years old, and it's like, that's not necessarily the thing that you want again. Like, why are 18-year-olds having conversations about dividends and yield? Like, it has already passed through to the next generation.
And this is the Sharesies generation.
Yeah, and they are not thinking about how to build wealth generally. Like, they are posting and celebrating dividends. So you can see those little nuggets of this focus on yield and income already seeping into the next generations. So there'll be negative consequences of this in some form again, 10 years down the line in another form.
You might think after a collapse like Duval that rules would be tightened around this kind of investing. Yeah, nah. The eligible investor exclusion enabling property schemes to target ordinary mums and dads with risky wholesale investments is alive and well, seemingly with no political interest in changing the regime. While Chris Walsh agrees we need better financial education, he also says we need tighter regulation to protect people.
It needs to be regulated. The wholesale model for this mortgage-backed funds, unfortunately, does need to be regulated. It may mean there's less development as a result of this, or it's harder to get the money, or maybe the properties cost more because they have to get from mezzanine lenders who aren't mums and dads or old like grandmas and granddads. You've got to regulate this because otherwise, I could set up something tomorrow and put some ads on Facebook and dust together a website, which would look nicer than MoneyHub's, and make it a thing. And who's regulating me?
There is always going to be another Duval of another shape and form, right?
That's Dean chipping in again.
That is the nature of the capitalist world we live in. People will try and flog something to someone, right? So how do you limit the impact, and how do you ensure that is managed effectively and without overburdening through regulation and everything else, right? So there's natural tensions here.
Chris remembers back to the days of the finance company failures and car financier Provincial Finance, which collapsed in 2006, owing investors $300 million. Provincial was endorsed by All Black great Sir Colin Meads, whose famous tagline was, "Solid as, I'd say." Meads said later that he would never do anything like it again.
Colin Meads was perfect for it. Lovely guy, lovely wife. It ticked all the boxes. I would say it was more marketable than Richard Long with Hanover. I think it was just so wholesome, so Canterbury, and people had no idea.
Chris is talking about property finance company Hanover Finance, run by Eric Watson and Mark Hodgson, which collapsed in 2010. It was famously fronted by Television New Zealand news presenter Richard Long, delivering the tagline, "We'll weather the storm." But when the storm hit, Hanover owed $554 million to 16,500 investors, and at that point, celebrity endorsements with messages of reassurance were nowhere to be found. Mark Hodgson did, however, front to media. This is him speaking to Mike Hosking on News Talk ZB in February 2011.
7:15, well, Mark Hodgson, it would seem, has become the poster boy for all that went wrong with the finance industry in the last couple of years. Hanover, when it was going, had $650 million worth of assets, was the country's third largest finance company. His assets are frozen. He allegedly lives on $1,000 a week in Queensland. And Mark Hodgson is with us. Good morning.
Good morning.
Do you worry about going to jail?
No.
Why not?
Because I didn't do anything wrong.
Part of what made Mark Hodgson the focus of the story was his affluent lifestyle. Sound familiar? A holiday house in Hawaii, the $38 million mansion on Auckland's Paratai Drive, flash cars, and a lavish 50th birthday party in Fiji that memorably included his personal trainer, all while being investigated.
Take away your cars, take away Hawaii, take away Fiji, you wouldn't be in the crap you are now.
Probably.
You regret it?
Of course.
Would you do it differently?
Absolutely.
I appreciate your time very much. Mark Hodgson, it is 7:28, the news next.
Despite the spectacular failures, despite the mainstream media coverage, Dean and Chris almost despair of Kiwis becoming more financially savvy.
But I don't think people remember those lessons. Like, that's the thing. It's like 10 years have been and gone and it's forgotten about. And the sort of due diligence, mental questioning or cynicism that you should have when seeing these things seems to have been forgotten about. Like, how many of us talk about or really remember the negatives of GFC anymore? It's an event that we talk about, but most people haven't changed behaviour now. Same with the mortgage funds, right? I think it's a small percentage of people that carry those scars and talk about it. I think a lot of others take no lesson from it at all, and it's forgotten about in 10 years' time, and the cycle keeps repeating.
The standard retailer, investor or wholesaler as they may be, is not thinking back to Colin Meads and not thinking back to 2008, not thinking back to South Canterbury Finance. They are seeing those things on Facebook. They're hearing about them on the radio. They're seeing gushy puff pieces in publications about the lifestyle of the founders. They're seeing Queenstown photo ops. They're seeing shiny things, sparkly things, flying things, and sponsorship and rugby, and that all looks very good.
Okay, bit depressing, but this is what we're addressing with this podcast. By creating a series that is hopefully easy to listen to and follow, we're aiming to deepen the understanding of ordinary New Zealanders. Because as psychotherapist Kyle McDonald says, anyone can get sucked into these things. Kyle has a private practice in Auckland and is a regular media commentator.
And I guess relevant to our conversation today, I spent sort of the first 4 or 5 years, actually mostly while I was training, working for the Problem Gambling Helpline, which is a very interesting way to start to understand the psychology of money with people, really.
One of the things that's important to remember about the way Duval styled itself is that it wasn't selling you something. It was helping you into an investment, solving a problem for you, if you like. Kyle says anyone can be susceptible to this kind of promise if it catches them at the right point in their life.
When we think generally about financial literacy, let's not assume that everybody understands how money actually works. It's easy, if you do understand investment and finances and are in a secure position yourself, to kind of look at this and go, how on earth could anyone ever get drawn into this? But of course, one of the reasons why people get drawn into it is because on some level they want to believe that it's true. And that comes from either vulnerability, from perhaps impulsivity, not really sort of thinking things through or not being able to think things through, or genuinely being in a place where actually, it would offer a solution to a whole range of problems in their lives that they're feeling overwhelmed with and not knowing how to solve.
Do you think there might be a bit of anti-establishmentism in there, in that some people think that it's inaccessible to them, this world of high finance, these financial advisors, these banks that, control so much money, and then someone comes along that offers them an in, that maybe offers them we've got the inside story here for you. Do you think there's a bit of that?
I think there is a bit of that, because actually if you talk to a registered financial advisor, the effective investment strategies are actually quite boring. And they take time, right? And so I think when people are feeling desperate, they're feeling vulnerable perhaps, or generally sort of temperamentally more impulsive, wanting to get the shortcut, then we can often believe what we want to believe. But again, I think let's not downplay the extent to which any of us can be vulnerable to an extremely well-pitched, well-presented, charming individual, absolutely forming a relationship, making us feel special and selling a solution to the problems that we have.
I encourage you to be the first one in your family to make it out of the matrix and to lead the way for future generations.
As we've discussed in this series, Duval made the most of the wholesale investor rules, which allowed them to market investments to people deemed eligible. Even the word wholesale comes with connotations. It makes it sound like the investor is getting a bargain, the inside running on a money-making opportunity. I've argued in the past that at a bare minimum, the term wholesale should be dropped and replaced with unregulated. Kyle says his advice as a psychotherapist for better financially educating people would be to help them understand that while short-term solutions are by their very nature appealing, good things do take time.
There's value in waiting, and actually not just that actually the small things you do, particularly when you're in your 20s, can make a massive difference when you're in your 50s. And I know a lot of people's eyes glaze over when you start talking about compounding interest, but making that relevant to people and recognising that actually very small sacrifices in the short term can add up to very big gains in the long term. I think when you start to sort of phrase things as, people need to give up something now, that's when you sort of end up sort of fighting against yourself, really.
Next time on The Fall of the House of Duval, are New Zealanders doomed to keep repeating the same investing mistakes? Or does a more financially savvy younger generation offer us hope?
Flaunting the money, and then the lawyer, accountant, and then all the other stuff.
Yeah, and then unregulated. It gets to a point where you're taking the piss.
Does the wholesale investment sector need reining in?
These groups are protecting themselves in a way by saying that they are targeting wholesale investors. But all it takes is a reshare, tagging one of your friends, or putting it into a different group. to take that completely outside of the context of wholesale investors to these regular mum and dad investors out there.
And what next for Duval?
No evidence has been provided to me or to the courts to justify the actions taken by the FMA.
That's next time on The Fall of the House of Duval. The Fall of the House of Duval is researched, written and hosted by me, Maria Slade. It's produced by Hamish Williams, with sound design by Mick Andrews and editing assistance from Lara Healy. Our executive producers are Duncan Bridgman and Jane Yee. Special thanks to Victoria Young, Garth Bray, Ethan Sills and Isabella Iramia. The Fall of the House of Duval is a Business Desk production for NZME, with the support of the Milford Foundation's Brian Gaynor Business Journalism Initiative and MoneyHub. For more on the developing Duval story, visit businessdesk.co.nz.